Okay. Hi, everyone. For those of you that have just joined, we're just here to give it a minute or so, wait for everyone to join, then we'll kick it off. Maybe just another 30 seconds or so, just for the latecomers. Okay, great. I think we can get going, and then for those who join after, that's all good. Okay, so thank you everyone for joining today's webinar where we're covering changes in the asset management industry and how that affects how companies market themselves. So we will be taking Q&A. If you scroll to the bottom of your screen, you'll see a Q&A section. Just click on that, submit your question. I'll receive that, and then at the end, we'll save some time to answer some of those questions. So as a quick introduction, for those of you that don't know me, my name is David Whyte. I'm the CEO and co-founder of Irwin. Irwin is an IR and capital markets software company with a mission to seamlessly connect the world's capital seekers, capital allocators to make them more productive, innovative, and successful. So I'm super excited to have these panelists with me here today. They are industry leaders. They have unique backgrounds that span across the buy side, sell side, and issuer experiences. We brought them together to have an open and honest conversation about the evolution of the asset management industry and how that affects the approach that investors take, that issuers take in engaging with investors. As everyone knows, capital markets is very much a relationship-driven business. So it's extremely important to understand how the various constituents interact as their business models change. And so with that, just a quick reminder also, we will be recording this session, or we are recording this session. We will send out the recordings to the attendees once it's complete. And so with that, I'd like to introduce our panelists. I will start with Peter Mann. And if each panelist could just tell us who you are, where you work, where you have worked, that'd be great. And then we can jump in.
Sure. Thanks, Dave. And it's a pleasure to be here today with all of you. My name is Peter Mann. I'm the president and co-CEO of Greyhawk Wealth. Greyhawk is an ultra high net worth asset allocator here in Canada. We work with about just under 60 families and a little over $1.3 billion of assets. We're really focused on building that sort of world-class institutional portfolio using some of the more exclusive opportunities around the world with some of the best managers. So my previous role, I was the co-chief investment officer of Gluskin Sheff, and I oversaw their equity and equity alternatives business.
Awesome. Thanks, Peter. Mike, if you could just give us a similar background, that'd be great.
Sure. And thanks, David, and thanks everybody for participating. My name is Michael Capomba. I'm the president of Bristol Gate Capital Partners. Bristol Gate is an employee-owned asset management boutique based here in Toronto, Ontario, getting close to $3 billion in assets under management. We are passionate dividend growth investors, but we do it in a different way, in that we use AI and data science with good old-fashioned fundamental analysis to build our two concentrated high dividend growth portfolios, our US equity strategy and our Canadian equity strategy. I've been here as president for about 7 years. Previous to that, I was at Merrill Lynch in both New York and in Toronto for close to 15 years. My last role at Merrill was head of global equity sales up in Canada. Maybe I'll just leave it there, Dave.
Awesome. Thanks, Mike. And last but certainly not least, Chris.
Thanks. My name's Chris Ritchie. I'm president at Silvercrest Metals. It's a sort of near-term producer, kind of getting close to the end of construction here of our project down in Mexico. Started my career in finance as a trader at UBS, more fetching coffees than trading back in the day. Worked at Canaccord for about 7 years, worked at National Bank, covered New York for about 7 years. So really interesting in terms of the crossover of moving from the capital markets over to Silvercrest. It's a very capitally intensive business. And one of my main roles was going to be to help finance the project. So we did about 7 financings in the last 3.5 years, plus a debt financing as well. So I think learned a lot of lessons in terms of how the mandates have changed dramatically of fund managers, how the mandates sometimes overshadow fundamental performance, things with scale and liquidity, and got a lot of benefit out of Irwin to sort of move from a relationship business, to scaling a big, massive capital markets program.
Awesome. Thanks, everyone. Okay, so maybe we'll kick things off with Peter, and then move to Mike from there. So maybe Pete, if you could, give us a bit of background about some of the changes that you've seen in the asset management industry over the last few years, the decade or so, and we'll start there. And then, this will be a very fluid conversation, but love to hear what you think.
Well, where to start? So I started in the business in 1992, and I jokingly have said many times before, when I started in this business, there was something called a liquidity premium, which effectively meant that you paid more to ensure that you could get your money back on any given day. We live in a world now that's quite algorithmic, and there's a massive illiquidity premium. We effectively pay so that we can't get our money back and mess up the entire process of compounding. And so a lot of, I think, the evolution of our business has really been, this very notion around active to passive, but it's more fundamental than that, in my opinion. I think it's really, we're seeking ideas where capital is flowing most. And candidly, there's been a very long cycle that's been proven out where with averages doing very well, it's hard for the preponderance of people to outperform. I mean, mathematically, it's not possible. And so with that very basis, people start looking at what they're paying for what they're getting. And I think that that's been the sort of determinant. I think probably one of the biggest differentiators that we've seen in the last number of years, particularly with, successful families, foundations, is this idea of how much of my money stays in public markets, how much of it stays in private markets. And I think that duality is what people are ultimately trying to source, because at the end of the day, is there a balance between the alpha that can be generated in parts of the market that aren't as regulated relative to the efficiency that the tailwind has brought for the market overall?
That's great. Yeah. So on that, I mean, Mike, you have some unique insight into, I guess, the U.S. market and how things have changed there, given your firm's strategy. So maybe you could talk a little bit about that, and how things have changed there, and how that may affect Canadian markets as well.
Sure, and just to echo a little bit with what Peter was saying, active management in the public markets has been a tough area or game last 12+ years. Or 10+ years, because of the vast majority of active managers have a hard time beating whatever respective bogey they're benchmark against. They tend to have higher fees, et cetera. And so as a small boutique competing in the active management space, and we are one of the very few firms in Canada, and I can count them on less than one hand, that's actually we have a business in the United States, and we are competing and earning business in the United States. So we have a good window of the market down there. And when we look at the active management space, I mean, we think that, looking forward, the areas that will do the best, I mean, certainly the biggest players in the industry are going to continue to do well. The BlackRocks, the T. Rowe's, the Capitals that can leverage their cost base, that can invest in technology, can invest in talent, can invest in new products. And that's one end of the spectrum. And then in the middle, there's a whole bunch of what I would call almost closet indexers that don't deliver competitive risk-adjusted returns, charge higher fees, and then they're losing money to passive in particular. But on the other end of the spectrum, there's some really great world-class boutique investment managers that we run across in the platforms that we operate on in the US, and those are UBS, Wealth Management, Citi Private Bank, and Envestnet. And they are competing in a sliver or pocket of the equity markets where they have a limited number of products. They run concentrated portfolios, and they have proven and durable investment processes that add value in that pocket of either the equity markets or fixed income or whatever have you. And so that's where we reside right now. We're delivering this high dividend growth portfolio that resonates as a strategy when you think of financial solutions for families where Peter's involved. And so what you're seeing certainly is fee compression in the United States. And if you can't deliver competitive risk-adjusted returns after fees for your investors, your businesses will have a hard time surviving or growing. But the U.S. always seems to be ahead of Canada in many respects when it comes to financial services, and asset management, wealth management. We're seeing that in the U.S. in terms of how competitive it is, how much fees have come down. But active managers that are delivering something unique or something special, there is a place for them to not only survive but to thrive.
Awesome. And so I think, Chris, you probably have some unique views here, having been on both sides of the table, but now on the other side of the table to Peter and Mike. How have you seen that affect how Silvercrest markets to investors?
Sure. I mean, first of all, the mining space is a totally irrelevant sector. It's, in the neighborhood of, 1-ish% of US benchmarks. I mean, we've seen market structure. That's the theme so far in the conversation right now is, you've seen fee pressure, financial disintermediation. The mandates of funds are changing to incorporate these things. So how do you become relevant within an irrelevant sector? And, again, I covered New York for 7 years. And the first thing I tried to do with the fund is, okay, what's your mandate? What do you do? What do you need? How do you, and a lot of people don't bother asking those questions when they're marketing and paying attention. And for us at Silvercrest, we very much try to create an investment vehicle that can resonate with the largest audience possible. So, I mean, for us, the first thing is size and scale. Right? If you're seeing fee pressure for an active manager competing against the passive market, which is now bigger than the active market, all right, you need, 2-3x the AUM in order to protect your own top line, right? And if that means you're probably putting more money to work per idea, right, as opposed to adding to your own G&A. So again, if you've got a company that's, trades $500,000 a day, when you're marketing, you need to pay attention to the fact that you're going after a $2 billion investment manager. It just doesn't line up. It might be odd time, but that would be way outside the normal realm. So you've got to really understand this dynamic, how it's changed so dramatically. Even in the retail sector, I mean, they've gone from commission-based to fee-based. As a retail manager now, your business is to gather assets. And if you've got a 1% fee overall, your business has gone from trying to make money from your clients is to not lose clients, right? So that's been a big, growth on the ETF side, even though I call it sometimes like diversification instead of diversification. I mean, if you buy Silvercrest and we go down, you've got 200 bad phone calls to make, and you really don't want to have to do that. So again, the way we structure Silvercrest and what it does for investors, how we think of the balance sheet, how we raised money, it was very much focused on having the broad reach and the broad audience and just making money for people as a way to gather interest.
That's awesome. Do you, Peter, Mike, any thoughts on that? anything that might have sparked as Chris was speaking there?
Other than we're totally irrelevant as a sector.
Well, maybe.
Sorry, go ahead, Mike.
Oh, I didn't say anything, sorry.
Oh, sorry. I would offer that's probably the most promising aspect of all.
Yeah.
The very fact that there is no relevancy to you probably adds to its relevancy. In all seriousness, defining, which is a lot of what I think people are sourcing today, and that is, how do you codify the process that enables you to raise capital? How is it that you bring an opportunity where you effectively close every exit door so that the one that they can walk through is the one that makes the most sense, both for the opportunity set and for what it is that you can deliver to that? It's the challenge, I think, within our commoditized industry generally. Everyone tells a story that they think is unique. Candidly, for most people, it just sounds the same as everybody else's story. And so how you narrate it, how you define what those exit doors are, the ability to be able to put it in front of people. I think the very fact that you know that there is negative asymmetry associated with those 200 phone calls to say that we've gone down by 30% means that you know how to position it so that you right size it. It allows for a different discussion and different, and again, not touting the work of Irwin, but that's a big part of where these things can be so beneficial. They can bring a lot more of that data-driven thought process to how it is that you present the opportunity as it relates to an investor.
Yeah.
And I might add quickly, Chris, as an active management firm, if you have high active share, which is the percentage, how different are you from the index that you're being tracked against? That's a kind of a good badge of honor for investment strategies. And so being different than the index is your best chance of doing better than the index. Now you can also do worse than the index. So as long as you feel you have a compelling value proposition to any class of investors, and because it's such a small part of the overall index in terms of your sector, it is different, and it can add elements of diversification to equity portfolios that can add some real value, as long as the investment kind of matches what that strategy is looking for.
Well, I know from just like things like with Irwin helps us track is, my goal going forward is to have something that's far more defensive than our peers. With a lot of mining companies, I mean, you're flipping a coin on commodity prices, and what your asset does is, everyone just, you got what you have. Like, there's only so much you can do. But having a extra robust balance sheet, if you can have a shareholder register where people tend to be underweight, you know what I mean? You can almost highlight the opportunity set if the market goes down. So it's almost trying to create a structure where if you can outperform in a down market, how do people think about that as a vehicle? So again, we try to really, get into that nuts and bolts, and we try to communicate that to shareholders so we can sort of craft as much as humanly possible a differentiated vehicle.
Before moving on to the next section, maybe I'd pose a quick question to our panelists. And if you can be so bold as to forecast what the asset management industry looks like 10 years from now, or even 20 years from now, what's different? Certainly, we're not going to hold your feet to the fire if you're wrong, but I think the audience would love to hear your thoughts on that.
Maybe I'll start because I work for an asset management firm. As I mentioned earlier, we think that you'll see more and more of this bifurcation in terms of the biggest players getting bigger, and on one end of the spectrum, and the other end you'll see more of these kind of what I call world-class boutiques that are in a pocket of the markets doing something really well. A few things really well and delivering great competitive risk-adjusted returns. I think you're going to see a lot more attrition in the middle. The folks that are what we call closet indexers that are charging high fees and not producing great results for their investors. I think the asset management industry is well behind other industries in terms of adopting technology. We can see that because we've used technology in our own specific way to source high dividend growth looking forward. But when I look across at our peers, many are really behind the times in terms of data science capabilities and in the world of AI, et cetera, in a digital world that we all live in. And so I think the firms in the asset management industry that stay behind the curve in terms of adopting technology to help them be better dividend growth investors or better growth investors or better value investors, whatever it is, or alternative investors. I think those firms are going to fall further and further behind. And the firms that really embrace technology to help them run their businesses better are going to be the ones that, again, not only survive, but thrive and do better within the respective, in that world of asset management.
Yeah. So more, if I could sum that up, just more sort of divergence between the firms that do everything, offer everything, do it really well, and scale really wins in that market versus the boutiques, more sort of point solutions. This is what we do. This is what we do really well, and come to us if you want it.
Sure, and you can think of boutiques as satellite strategies. So even if an investor is a passive investor and they believe it's so hard to beat the S&P 500 over time, I'm going to own the SPX. What I say is I never try and convince them that that's not the right thing to do. As I will say, instead of putting $100 into the SPX, give us 5 or 10 of it, because we can complement that exposure to the SPX because we're different than it. So, what we say is we don't hurt you in the upside, but we help you on the downside. And so, I spend a big part of my time trying to convince investors in family offices or institutional investors that we're just a piece of the pie. Whether it's 1% of the pie or 5 or 10, it's the experts like Pete and folks like that can decide. But you can, as long as we can convince you to sort of take a look at us as a piece of that pie for the financial solution for whatever investor there is, that's key. And so it doesn't have to be a passive or active question. It can be passive and active, and that's how we run our business.
Got it. That's great. Peter, any thoughts on that?
Yeah, I mean, I would agree with much of what Mike said. I think the only differentiator I would sort of define it as is that really the barbell for me is advice at one end and product at the other. And that's really the disintermediation that I think you've seen globally that hasn't really manifested itself yet here in Canada. And that is that because the distribution channel is controlled by a few, it makes it very, very hard for that open architecture to exist. But I think that largely where we're heading is towards a world of allocators and a world of very high quality managers. And everything in the middle is really kind of gets washed aside by the world of ETFs and efficiency. And I think that, there's some component of the portfolio that goes towards pure alpha strategies. There's some that go to exposures that Chris would talk about as they relate to certain areas of the market that most people either don't have enough of or don't understand. But candidly, I think really it's that separation between advice and product that will be the most paramount change within our industry. Because candidly, it's very hard, as I love to say, to look someone in the eye and say, we run 9 strategies and it just so happens that they're the best 9 strategies in the world. Because the reality is that typically 1 or 2 of them are good or very good. 3 or 4 of them are average, and 2 or 3 or 4 of them are garbage. And the fact is that if you capture someone in only that realm, you really end up selling what is working rather than what is most optimal.
Yeah, absolutely. It's sort of the age-old problem of the asset management industry. Chris, any thoughts as to how you would or are positioning Silvercrest, given what Mike and Pete just said, like looking to the future? I know you're known as one of the top corporate marketers in your space. So I'm sure the audience would love to hear about some of the strategies that you use to remain effective and differentiated. I know you're always looking to the future. So, those comments are surely very relevant for you.
Scale and commoditization. I think both what Mike and Pete said are spot on. You go back to when Michael Lewis wrote what was his first book. I can't remember the name. It's slipping on me. But the whole idea of putting people together who need money and the banks that can provide it. And then all of a sudden, when you're taking outside capital, everything sort of started to change. So when you start to see a world now where it's all scale, 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 fee pressure coming down, well, the people raising money for companies, it's the small companies that don't have money. And there's almost like going to be a bigger gap between the whole sell side business of where their margin lies, because it's the only margin remaining is raising capital. But the preponderance of capital is shifting away entirely. So I think there's going to be a big chasm between the business models of the research coming out of the sell side and how people actually gather information. How does a retail investor get access to information these days? I think it's a little scary with where we are in the market cycle and in terms of how people are getting their information and using it. We'll see how this current wave ends for people. But I think there is going to be a big differentiation. And again, when you think about the sell side, they have their clients, and their clients tend to be people who are a little bit more active, and they create revenue for the sell side. I can't fathom to know what small percentage of the overall amount of assets out there that represents. So for us, in our next phase, when we raised money, we tried to make money for everybody. We told people we tried to raise about a third of the money of the demand we thought we would have, to make sure that the stock traded well. And people look to us, our financings were money making events as opposed to sucking all the demand out of the stock. So we end up raising money every 5-6 months, as opposed to raising what we needed to get us through. It was always making sure you're making people money there. The next phase for us is, how do we create a vehicle that's attractive to a family office person, right? How do we find someone who's looking at alternative products and sneak in there as something that's viable, right? So again, having something that a hedge fund would call a lazy balance sheet, hopefully for a family office would say, you've got a really robust defensive positioning here that allows you to outperform in a down market. So we're trying to think about something entirely differently. And that one last thing on scale before I turn it over would be, if we have a shareholder register that's extremely differentiated from our peers, and then if we happen to buy, sell, merge with company ABC, well, on a pro forma basis, if we have a different share register with that company, the buyers that are much bigger and need scale and want that diversification, there's a good chance that they're going to be underweight the pro forma company. So to me, I actually look to creating a differentiated share register as an asset to bring to the table when you look at corporate activity. And again, that's going to be largely outside of the sell side realm. So, whether I'm successful or not, we'll see. But really trying to get outside the realm. And again, having the scale and being able to track all this through Irwin, I couldn't do it, with a spreadsheet.
Yeah, that's great. Go ahead.
Sorry, I was just going to say that's super fascinating, Chris. I love that perspective. You don't hear many people think about it from the cap table perspective, and but it's very true. And these are some of the things that they are the inherent tailwinds in the market. That, as this flow of capital is such an essential component of it. And if you can create an opportunity set that allows for almost a forced flow of capital, it changes the entire prospect of what a deal looks like.
Yeah. And we're doing that through Irwin. Who are our top 200 prospects? And they can be retail brokers, precious metals funds, resource funds, ones that can't own us yet because we're not there, family office. Yep. And then if we can track what's a normal position size for a company of our size and sort of stage of business, and literally target them to be half of that and tell them that, and then actually encouraging them to be buying on dips because we've created something greater on the defensive side with the balance sheet, cost structure and whatnot, you can hopefully almost create outperformance in a down market, which sometimes becomes self-fulfilling, right? And then if you can then, as you grow, because again, we hope to be able to grow and add value on an NPV basis, you can find marginal buyers going forward. But I couldn't, breaking into, Mike and Pete, like funds of your sort of dynamic, like I feel like we're probably, need to be 3-4x before, anyone would contemplate single asset mining companies. Like we're just so far off the radar where the industry's at.
Yeah.
Hey, Chris, one of the things that we appreciate is, and even though you might not be in our investable universe right now, we appreciate companies that make it easier for us as an asset manager to get up to speed on the business in terms of analyzing the business. And so, we love it when, and not very many companies do this, but if you can provide information, you have one asset, but companies that have different businesses or divisions or segments in Excel form to help us get up to speed on a name. I know that goes a long way with our research team to, even in terms of their willingness to look at a company. And some companies are really good at that, at doing that. And I'm just thinking about the U.S. market now. But when I think of some of the names we own Texas Instruments, and they're great at sort of spelling out how they view their capital allocation policy, which we think is one of the best in the business. And so we completely understand how they allocate capital. We own a company called American Tower, and every quarter, they have 3 divisions. They'll do a deep dive on a specific division in a quarter, just to sort of give you some more color. So, being able to, for a company to sort of help investors get up to speed on a name and understand it better in terms of, considering it for an investment is something that I think a lot of companies, even big US public companies, can do much better.
Yeah, absolutely. Pete, I'd like to shift to you for a second, because I know you've met with thousands of companies over the years. And I know you have amassed some frustrations around some of those meetings and the preparation of some of those meetings. So maybe you could just quickly take us through some of your top do's and don'ts as it relates to meeting with investors, organizing those meetings, and follow-ups.
Yeah, again, where to start? So look, I have a very high bar, as when you enter a room with the management team. If you're not prepared, you shouldn't be in the room. That's number one. And candidly, at least in my experience, certainly from a group perspective, I would say anywhere from 80 to 90% are not prepared when they come into the room. They're looking to be force-fed information that candidly is, boilerplate. It's canned. It adds no value to the decision-making process. The questions you could basically, determine prior to arriving. I will flip that though and say that quite often I would offer that there are management teams that come that aren't very prepared for the discussion either. They don't come with the depth of understanding of whom they're sitting with. I mean, Chris's understanding and being able to dig in on who's there, why they're there, what it would mean for them to be on their all of those things are not well contemplated, particularly for non-Canadian companies coming to Canada looking to raise capital. They barely know who you are. They've never heard of it. And so they don't come prepared very often. This confluence creates the struggle. And so you have this creep around indexing, around the idea of hiding behind someone else's work or someone else's idea. And management teams do it, and investors do it, and opinion. And, towards the end of my time there at Gluskin Sheff, focusing instructed. And I think that there is a way for people to be brought up to speed, but it still really comes at the heart of one's willingness and desire to understand why it is they're there and what they're solving for. And preparedness is probably the single most important thing that you can do as an investor. And the reality is that we've gone through phases where we're in the midst of one right now where preparedness has been, candidly, it's probably diminished returns more than anything else. And that's hard to articulate to people when it comes to the understanding of meeting with companies.
Yeah, that's great. Pete, you might just want to turn off your camera. I think your bandwidth might be running out a little bit there.
Sorry about that.
Yeah, no worries. I think we caught the vast majority of it. Chris, maybe flip that over to you. Is there anything that you do? What's maybe just take us through your steps to prepare for those meetings?
I mean, understanding a mandate and why. I mean, if I'm pitching to a resource fund, that's different than a precious metals fund, I mean, making the analogy between what's going on in the energy trade right now with ESG and drawing parallels to mining and moving forward on things like that. The pitch is totally different. Like what we do within a portfolio is very much a focus of mine. And, and it's one of those things I think is often just not done enough, is try to listen more than you speak. If you're getting to know someone for the first time, I try to spend the first 15, 20 minutes just asking questions. And part of that is, do your prep work ahead of time, as Peter said, which is definitely mandatory. But the momentum that we've been able to achieve by making people money, being transparent with our business, our shortcomings, here are the key risks, don't hide them. Like if, telling someone there's nothing wrong with your business is the surefire way of making them not believe you at all.
Yeah.
But really asking that question, what would we do in your portfolio? If we were big and relevant to Peter or Michael, are we an inflation hedge, or would we be something like that? Or what would we do in your portfolio? Are we a portfolio hedge? Like refining your pitch and refining your business model to make sure you can have an audience that is interested in you. You'll get all the information you need by listening and asking those questions. And over time, you just get better at providing the investors in that bigger group with what they're looking for. If you don't listen, you just walk in and preach, you're wasting your time. I like one last thing here is they always say 50% of your marketing is well spent. You just don't know which 50%. I use that as, a way to, how we spend our time, really making sure we have a good idea why we're using our time and resources in a certain way.
Yeah, absolutely.
And, David, I think Peter brings up a good point too. Investors have a responsibility to be prepared when management gives them an hour, or whether it's a one-on-one or a group lunch or a Zoom call. I think a lot of investment management firms have been guilty about not being prepared enough, and we're looking to be force-fed some relevant information. And so, we're not a huge firm with close to 3 billion, but for some of the smaller S&P 500 companies, and they're not small by Canadian standards, but they're small by Apple and Microsoft standards, because we tend to be on page 2 of the holders list at our size now. We typically get a call from the company when they come to Toronto, whether it's through JP Morgan or through an independent firm, or et cetera. We make sure that we're prepared when we go into that meeting, because we know if we do it right, it's going to obviously be very useful to us and to our unit holders. But I think Peter makes a good point. I think it's incumbent on both sides, the issuer and the investor, to sort of squeeze the most out of that 1 hour, whatever the number is, an hour meeting, et cetera. And so that's something that we take seriously when we meet our portfolio companies, which we're lucky enough to do more and more now as they come to Toronto. But that's a good point that Peter made it.
Well, on the back of that, I mean, we've all had experience with this. Some of those meetings are set up by the sell side, and some of those meetings are what we call favor meetings, whereby the sell side says, hey, Mike, can you take this meeting because I can't fill the slot and you owe me one, or I owe you one. And then you take it and you page flip, not saying you do this, of course, but I've seen this. I'm sure you've seen this, and Chris and Peter. And, then it just doesn't work for anyone. And that one of the things that I think we should all be excited about is, the fact that, going direct to investors or direct to issuers is growing and has grown significantly. And, I would guess at least that the quality of meetings has risen quite a bit as a result. And so maybe we can talk a little bit. We haven't really touched on it too much, but I think it'd be worthwhile, given the panelists, all of us have experience on the sell side. So I think it'd be worthwhile just quickly touching on what are the changes that are happening there, and how is that affecting both the buy side and the issuers? Because I know we all have a lot of opinions on that. So Mike, maybe if I could kick it back to you, you spent a lot of time with Merrill Lynch. The roadshow business, the corporate access business really well, and the cash equities business really well. So maybe you just speak to that.
Sure. I mean, it's been over 7 years since I've been on the sell side, so I know there's been a lot of change when I was there, but there's been a lot more change since I've left it. I think it was I can't remember if it was Chris or Peter said this earlier, but the cash equity business is not a profitable business. If you're lucky, you're breaking even and you're making money on new issue. You're making money on, if you're a big player, on derivatives and kind of higher margin product. But when I was running the desk at Merrill Lynch, I would never have given a meeting to Bristolgate for a one-on-one, because we can never pay Merrill Lynch or JP Morgan or whoever it is, back when I was running it, enough to sort of justify a one-on-one. The reason we get meetings is because the companies know we're a big shareholder, and they specifically say you have to offer the meeting. But the street has changed. There's been massive changes to the way companies market themselves, and I think Chris is testament to just listening to him talk about how they face off against their own investors and potential investors. It's just incredible. That I don't know that really existed when I was on the desk at Merrill. So the business has changed. It's much more commoditized. It's technology has become it's become a real technology is kind of fundamentally changed that cash equity business. I still think corporate access is really important. That's why Irwin is doing so well and helping companies like Chris's. And so back when I was running the desk, it was a real competitive advantage, and your bankers brought in relationships with typically the management teams, and you had some access to take them across the Canada and US to see some of the biggest investors. And I guess that doesn't really happen as much as it used to when I was on the desk.
Yeah, absolutely. Chris, I know you have a lot of opinions on this, but maybe before that, Pete, I thought I'd see if you have anything to add.
Yeah, this sounds very callous, but the cash equities business doesn't matter anymore. They're no longer necessary. They're in the way most of the time. Chris just pointed out the path at which he wants to optimize things. Mike just got through saying that if they're on the cap table and the management team respects them and wants to see them, all of a sudden, all of what was trying to be solved for, there was something around exclusivity that existed before that is now gone. And the reality is that trying to get paid for something that you don't add any value for is part of our challenge as an industry overall. And cash equities doesn't make any money, and candidly, it doesn't deserve to make any money. And that's why it doesn't make any money. And I think that we're kind of seeing that through many of these sort of institutionalized forms. Bill Miller had this great line one time where he said, capitalism is about finding large pools of capital and making them vanish. And the reality is that when you over-earn, like cash equities did for as long as it did, you go the other way and you under-earn. And the reality is that I would say it's compensated fairly for the value that it adds.
Thanks, Peter. Chris, you told me a story recently about some experience you had with the sell side, and I'm sure the audience would love to hear your broader view as well.
Well, it's again, we did 7 or 8 financings in a very short period of time. We had the I guess I don't know what the right word is, ignominy of doing a bought deal an hour and a half before the World Health Organization declared pandemic. And that was a 2 times oversubscribed bought deal that got canceled by the sell side, on a bought deal. So, for us, I agree with Peter and Mike. The business model of the sell side hasn't shifted yet. They're still trying to milk the cow here that's been so lucrative for a very long time. And I've rarely had someone ask me, Chris, how can we help you? They tell you how they help you, but it's not necessarily helpful. For the amount of resources they have, they just haven't changed direction of the Titanic. The ship hasn't changed direction yet on how to do so. We talked quickly about needing capital. It's a lot of these small companies. If you're a 200 million market cap mining company that needed to raise $1 billion over the next 5 years, you're on everybody's top list. But that's not going to be on the radar for Mike and Peter. So, they're catering to those people. And again, the audience that would be playing in that sandbox is shrinking and shrinking. So I think there's just a big dislocation. And it's like I said, for me, I'm trying to spend more of my time outside of that realm with the different capitals for the different share register on that side of the scale. I think our challenge now is we're done raising capital, so for the sell side, if they're determining their own business model, which is, again, you always ask what everyone's business model is. If their business model is on raising capital and winning banking business, if they don't feel as if we're going to be a client for that, they're going to drop coverage or not pay attention, right?
Yeah.
So just, anybody who has a company that relies on the sell side to do their marketing for them, to do their outreach, to do their share register planning, to do any of this activity, I just, scratch your head a little bit, because unless you're willing to sort of turn that over to someone as a third party that doesn't have the skin in the game, that's a tricky thing to do. So how would you resource your own capabilities? So, I mean, there's definitely people that I find helpful. But at the same time, I'm at the point going, I just couldn't turn over any of my marketing business to the sell side. Like, I just don't think it would be responsible.
Yeah, absolutely. Yeah, and I thought for those of you that don't know my background, I started on the event-driven hedge fund sales desk at Credit Suisse, and I love that role because it was very entrepreneurial. I used to get to model my own ideas, be them right or wrong, probably most of the time wrong, but still I got to do it, and then pitch it to the hedge fund managers around mostly corporate actions, and it was I felt like I was really adding value. And then Credit Suisse shut down that side of the business and made me what I call a plain vanilla equity salesperson, which was frustrating for a few reasons. One, it was super boring, and I had a tough time not falling asleep in the meetings. But two, there was a very significant conflict of interest in how the meetings were being allocated, and I got really tired of taking CEOs and CFOs to New York or Boston and having them, chew me out in the car ride on the way back as to why we were meeting with certain institutions. And so it became very clear that was a friction point. And then the other thing is, there's everything we've talked about today has caused, a significant shift in how, all these parties interact. And I started getting calls from my buy-side clients saying, we are no longer going to, maintain relationships with 120 different sell-side brokers. We're going to maintain relationships with 20 of them. And maybe you'll be on the list, maybe you won't, but we're only going to pay them. And therefore, we're only going to take meetings with them. And what that means is that it puts a immediate pressure on the issuer to then essentially become a capital markets expert. And, Chris, you're a great example of this as to why you're in that seat, because now the onus is on you, the pressure is on you as an issuer to do the things that banks historically have done, I would say, or should have been doing. And so as a result, there's been a big shift, and all these, factors come together to sort of erode the value of the sell side. I don't doubt that, it's always going to be there. I mean, we talked about cash equities specifically, but, the power of a balance sheet is significant. Chris, I think, you guys have used that before, but things just change. And I think one of the main, or the biggest things to look out for when you're trying to identify the changes is understanding those business models, what's driving them first. And so I think that's why this conversation is so important, especially for issuers as you're trying to target. Maybe unless Peter, Mike, and Chris, unless you guys have anything else to say, maybe I'll put it out there first and then we can go to Q&A.
Actually, I just want to say it's amazing to think that Credit Suisse shutting down the event-driven hedge fund desk, which forces you to the boring general sales desk, which drives you crazy, which forces you to say, I got to do something different in life. And then you create Irwin. I mean, that's kind of a great background and story, I think, and, a real testament to the kind of character you are.
Yeah, thanks, Mike. No, I appreciate that. Okay, great. So I'm just we have one submitted question, and then prior to the meeting, then one question from the audience today. So one of the submitted questions was, and I don't think we touched on this. So, and Peter, maybe this would be good for you, actually all of you. So tips, what are some tips for follow-ups after one-on-one meetings? So if you're an issuer, how should you then be engaging with the investor that you just met with? Maybe Peter, maybe we can start with you.
Yeah, I mean, look, I think it's ultimately what you're trying to solve for within that meeting. But say it is on the basis of what Chris would talk about, the idea of them becoming a shareholder or a larger shareholder, or have a greater depth of understanding. I think it starts with the simple things that most firms don't know how to do very well, which is the cadence of thank you for your time, thank you for your effort. That is not an IR email that goes out. That is an email that comes from the CEO who was in the room, or the most senior person. I think there are basic courtesies that go a very long way for people's understanding as to how it is, the time that's been committed, making a personal connection associated with it. It's no different than anything else in life. But the problem has been is that it's been systematized to a way that is supposed to create efficiency, and what it's actually created is just boredom. And so no one's really that interested. The people telling the story, the people hearing the story, rinse, repeat, let's roll around again tomorrow and do the same thing. I mean, it's comical. It really, truly is. And when you put all that on the table, I hearken back to what we were just talking about earlier. It's not hard to determine why this is a zero return business, cash equities at its simplicity, because there isn't a whole lot being done as to consider the points. For me, it's always about hitting on the most relevant pieces that add value. And that can come in the ability to narrate what the story is, how relevant it can be, what it means from a longer term perspective. I think all of those things need to be done more optimally. But the reality is that more often than not, you have a meeting, you get a little feedback questionnaire from the broker that brought them through town 2 weeks later, and it's a 2-sentence response of, did you like it or did you not? I mean, it's hysterical. It really, truly is.
Yeah, absolutely. Michael, I know you sit on the investment committee at Bristolgate. Have you seen any follow-ups from meetings that have caught your eye?
I think, back to Chris's point, as a corporate, know who you're talking to and what they're looking for. And so we want to buy quality companies, but we have to buy dividend growth companies because we're a dividend growth manager and we run dividend growth portfolio. So, keeping us up to date on capital allocation, and specifically as it relates to dividend policy, or, progressions in that policy or changes to that policy, would be a smart way for companies that we either own or are thinking of owning or considering owning to, if I was in that IR department, I would make sure that any color around capital allocation and how that results in an evolving dividend policy would be obviously very important to us. There are some companies that are very good at spelling out their dividend policy and how they think of it. Most still, even in the world of the S&P 500, are not. And so we appreciate it when we understand how management thinks about dividends, especially dividends going forward. And so for us, that would be kind of a layup to sort of as a follow-up to keep us engaged in terms of it would be a very good follow-up for us.
Awesome. Chris, any tips of the trade in terms of follow-up, building that relationship?
Yeah, it's more dialogue than preaching.
Yeah.
I think, like, for example, like this energy trade I've been going down the rabbit hole on that. Again, the ESG dynamic, I mean, the capital returns, drawing the parallels, asking the questions. Do you think that's relevant? Do you think this changes? And how would you suggest we shift what we're doing to make sense? Like, I look for advice, and there's plenty of times where people are happy to share it. But I mean, we do want to do more listening. One of the goals that we have for next year is what we want to do is 15-minute marketing. That's one of the powers of Zoom, the boredom and the wasting of time and not being prepared. When we put out news releases and whatnot, we'd love to send out an email with the trading details, the liquidity, the volume, relative value, key risks, where we set up. So if someone reads a 3-minute email and they feel like they've been given an update, they don't want to talk to us, that's a success, right? Because we've been more efficient with people as opposed to trying to fill an hour. And if once a quarter people want to do a 15-minute meeting and it's like, okay, here's what we think is relevant, we're happy to. If we can get off the phone in 15 minutes and make that the goal, we're hoping people see that as valuable.
Yeah.
Right? As opposed to, if it goes longer, it goes longer. But, how can you keep people informed and it's back and forth? right? Then it's mutually beneficial. If I'm seeing something has nothing to do with Silvercrest, and I thought that it was relevant for what the person on the other side of the table is looking at. If I share that, I'm creating a chance for dialogue, because how do you meet someone once and then maintain a relationship if you're not helping each other out?
Yeah.
Right. So hopefully there's a dynamic there that we try to do as opposed to just, here's a research report, go read it and then buy it. Like, it's just expecting anyone on the buy side to do extra work, on something that you haven't really done the work for them. I just don't count on that as being a good strategy.
Yeah. I mean, we all know this, but capital markets is very much a relationship management business, IR very much so as well. And I like to give this sort of analogy as to dating, where like the deeper ingrained you are in the relationship, the better you know the person, it's harder to break up. So as issuers, I mean, that's sort of what we encourage our issuers to work towards. And Chris, I know you do too. And Mike, you actually mentioned a interesting comment to me last week where, you try to do the opposite, right? You try to form relationships, but you really try to remove any kind of emotional bias and really just look at them as company as securities. So I think both parties just need to be aware that that's at play, and how to optimize for it. Sorry, go ahead. Yeah.
I was just going to say, in our specific case, and just so Chris knows this, is we love to talk to management teams when we need some information that we feel that we don't have or we're unsure of. But we're not going to play the game that I played for years at Merrill Lynch, where you're social with management team, you're golfing with them, or in our case, Chris, we're playing tennis together, wherever it is, and we're out with our spouses or for drinks. Is we don't want emotion to enter our investment process at all. We want to have a relationship with management, but we want to try to minimize emotion, maximize judgment when we look at companies, and so that's what I was referring to, Dave, last week.
Yeah, makes a lot of sense.
Dave,
Okay,
Dave, there's just one other thing I'd just add to that, because I think it's really relevant. And there is this age-old dance that goes on between the investor and the management team, and it is what the investor wants to know when prepared and what the management team wants to tell you. And the fact is that those two things are rarely the same, and that is why preparation is so essential on both sides of the equation.
Yeah, absolutely. Okay, we have time for, I think, one question from the audience, and I think it's a good one for Chris to wrap up here. And the question is, if you had to choose one thing that IR teams should prioritize heading into 2022, what would that be?
Preparation.
Yeah.
Again, if you're meeting with somebody, you should know what their mandate, what they're looking for, and you should tell them that you've prepped for the meeting with that in mind to show them respect for their time. And if you're wrong or you're close, I'm hoping that, a Michael or Peter, if you've done a good job at trying, they're gonna give you a little latitude, and you might get a second crack and you get a chance to keep the ball going. A lot of people just speak at people. So I think really understanding the mandate and the business model of the person on the other side of the table will give you 3/4 of the information you need to communicate on the same wavelength.
Yeah, that's great.
Dave, maybe I can just add quickly, I tell our sales guys, you want to always get to the next meeting. The best way to get to the next meeting, because nothing happens over a meeting or over a short time period, certainly in my side of the business, is you want to get to the next meeting. And the best way to get to the next meeting, or the best chance to get to the next meeting, is coming in prepared and being able to have a good informed discussion where you can cross over as much as you can. As Peter said, sometimes you're kind of you're not crossing over as much between a company and an investor, and so it's all about getting to the next meeting, and then eventually you want to get to doing business, but the most important thing is getting to that next meeting, and the best way to do that is being prepared, as Chris said.
It's awesome. Okay, great. We are running out of time. This has been amazing. Chris, Mike, and Peter, thank you so much for your time. To the audience, thank you so much for attending. We will, as I mentioned earlier, we will be sending out the recording to the attendees. And if you have any questions about Irwin or anything like that, you can email me at david@getirwin.com. Thanks, everyone, and enjoy the rest of the day.
Thanks for everyone.
Thank you
Appreciate
very
your
much.
time, everybody.
Nice
Bye.
to see you guys. Thank you. Bye-bye.
Thanks.